Welcome to the Dividend Talk podcast, episode 227. 2024, the year in review. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Can you believe it's our last podcast of 2024? How was your Christmas? Was it good?
Really good. Lots of food, of course. Oh my God. I mean, I'm a slim guy, but I think I need to sport a little bit extra in the upcoming week because this was simply too much. I mean, I've been really stretching my let's say my capability to eat by a mile. Unbelievable. How about you?
But you have. Is it Christmas Eve you have it, or is it Christmas Day you have the big dinner in Poland?
All 3 days.
All 3 days.
Christmas Eve is the one where we don't eat meat, so it's a lot of fish, a lot of cold stuff. But you know, it's a three-part meal. So and then the next day it's again the breakfast, and then a dinner, and then a breakfast, and a dinner, family, cake, sweets, everything. So it's just like more than my body can handle. But, you know, it feels good, of course, right? Those nice sitting at the chimney, the whole family there, watching Home Alone again. Of course, it's kind of a tradition. So, yeah, really enjoyed it. It's really nice.
Yeah.
How's for you? Because I think you've been partying, right? Totally different, I guess.
No. Quite similar. Christmas Eve is similar. Christmas Day, and then obviously St. Stephen's Day. So St. Stephen's Day is more of a drinking party day in Ireland. Lots of stuff go on. But what we did is we made up with the family. All the kids are around during the day, and then during the night, then adults will play cards, have a few drinks, and so on. But it was pretty late last night. I was about 5 a.m. by the time I got home. So
wow,
it was
wow.
It was good. But no, it's nice. We have a big family, so there's lots. I mean, there must be 18, 19 kids there. Some of them are getting older than the adults, 16, 17. So it's a nice age group.
And do they all know that their uncle is the host of the famous Dividend Talk podcast?
Of course. I've shouted out to a couple of my nieces on the podcast. They love that I have said their names on it, and they keep listening to it all the time.
Okay.
So they know it. So
did you give them some dividend stocks for Christmas?
Yeah, no, I did not. I did not give them dividend stocks. I'd be broke. I just said there was about 18 kids there.
Yeah. I've been doing that like for several years now, and not for 18 kids, but for a few. And yeah. Of course, not the best performing. The first stock that I bought them was Disney at $150. Dividend got cut now.
Yeah,
but trading it on that.
But my son is still doing it, and he still buys his own stock. So he got some money over Christmas, and first thing he said, he wanted to buy a new top and invest in dividend stocks. I was just laughing at him. Yeah. So I was there. It doesn't need to be dividend stocks. You're only 14. It can be anything else. Not just because I have a podcast. It doesn't have to be dividend stocks, but you know how they go.
Nice. Yeah, hey, but you know, this podcast is really about the year in review a little bit, right? So that was Christmas, but Yeah, because next year we'll start looking forward. We will do our performance review and everything for the year. I will be writing annual reports next week again. I will start with it on the first day of January. But for me, it's always nice to really reflect a little bit on the year as well. And I think we really should start talking when we reflect on the years about the guests we had on the show, right? Because I think for me, the guests are usually one of the highlights. We had 7 this year, way too few.
Yeah, yeah.
As a minimum, we should be having on average 1 a year,
One
1
a
a
month,
month,
1 a month.
1
Yeah,
a month. So we need to do better,
yeah.
definitely, for that in
And
2025.
we started off strong. We had 4 in the first 8 weeks. We had 1 every 2 weeks.
Wow.
And then, so we had 4 in the first 8 weeks, and then we only had 3 in the rest of the year. So we definitely started strong, and then we took our
Yeah.
foot off the pedal. But we have some guests lined up. We have 1 definitely confirmed for the start of next year. So
Yeah.
let's try to 1 a month. That should be our goal.
Exactly. That should be our goal.
1 a
But
month.
for me, the most iconic one was definitely Chuck Carnevale, Mr. Value from Fast Graphs. I mean, I love the guy. To me, he always reminds me a bit Warren Buffett. It's probably because of the age, the way he talks. He talks also in such a way that everything feels so logic. Yeah.
Yeah.
And
Yeah.
it was such a nice, and he spent so much time with us also afterwards. Very talkative, very generous, really awesome guy.
Yeah, even before and after, he was very, very engaged.
Yeah.
I think he was just really nice to have on the show. And I remember Medical Properties Trust was in a lot of trouble at the time.
Oh, yes.
Probably still is. He was betting big, not betting big, but he was still confident in them.
Yeah.
And I believe there was some good news after that. They sold some of their, I can't remember. There was about 4
I'm
or
not
5
following
weeks.
the stock.
But yeah, Chuck, I just remember in our show notes, we had Chuck will be happy. Because they sold, I think, 5 of our companies or whatever they did. I can't remember.
But I bet, I tell you, I think he must be in the 70 or something like that. Yeah, but if I would be at that age, I would still love to have our podcast at that time. Imagine that 30 years from now.
He had so much passion for it.
Yeah, I think it keeps you. I think it keeps you actually alive, right? If you're just all the time keeping your mind busy, you're analyzing stuff, you're using your brains in a good way, you're in touch with people, you're just in the middle of society, even, right? I think it's really important.
Yeah, and I think, and I'm taking credit for this, but I think we opened them up to more European stocks after that.
Yes, I remember that.
He certainly started covering a lot more European stocks on his YouTube after that. So I think we were the gateway into that. And if people benefit from that, then we've done our job.
Exactly.
But what about Canadian investor? He was our first guest on of the year.
Yeah, what I really liked about him was, I think it was the first real person that really retired on dividend growth investing that we had on the show. Yeah. So it was really interesting for me to hear how he spends his day, what he does, how he looks at retirement. Because you often hear like people saying like, I went back to work again after a few years or something like that. But for him, nope, not at all. So I think this is really personal. That shows like you can really have this kind of pocket mentality. Sorry for my words. Or you can just be, I don't know, tomorrow do the dishwashing at your favorite hotel and experience how that is. Like you can do like literally, you have the chance actually to do most of the world's dirtiest jobs just by following the Discovery episodes and trying to do that as well. Yeah, you can just do all of that.
Yeah. No, he was quite inspiring, and you were right. He did have that kind of attitude, like "F you, I'm retired. I can do what I want, and I don't care what anyone says." And it was quite refreshing to listen to, and a little bit taken aback at the time, but it was nice to have him on. And then, of course, we had ex-Berliner and Grandpa's Rules on. That was quite a fun show, I have to say.
Yeah, and I really wanted him on the show because it all started out on Twitter when he once replied to a tweet of mine with his grandfather's rules, and he came explain them. And for instance, for me, that really stuck one that stuck with me was like, you don't need to be the richest man at the cemetery, and that's why I really prioritize now. And then one of our favorite listeners, Ron, he reached out as well with the book Dying with Zero. So I read that book as well, and it really made me think a lot about my own relation to money, let's say. I did the checks. I feel like I'm okay, but I'm even more aware now of not postponing, let's say, the things you like
Yeah.
to later and all the time. I've never been really doing that, more taking like life as it comes.
Yeah.
But it's so easy to say, like, okay, let's postpone this trip another 2 years. But in 2 years, your kids will be older. Yeah, as an example. So
Yes, he had that as rule number 8, didn't he?
yeah,
You don't have to do anything except die, so live it the way you want.
exactly.
It was quite a good. I think that was quite an eye opener. It was again a different perspective.
Yeah,
22 rules, and not always all about investing, keeping the money, about life and in general.
yeah,
So it was
exactly.
pretty good show. And then we had Lana, of course, from Pepper Shares, and I listened back to that this morning. Yeah, when I was going through show notes, I listened back to that, and I just realized that in my notes I had green pepper down. I was writing something, and obviously her name is Pepper Shares. So when I was introducing her, I said green pepper, and nobody told me. And I listened back and oh no.
Yeah. But for me, it was really refreshing because actually, to her credit, was the first female we had on the show, and it's actually a pity that it had to wait so long to get the first female. But we see that in the statistics as well, right? I think 96-97% is men that listen to us, typically of the age of 30 plus. Yeah. I guess we attract the same kind of people, but it was really refreshing to hear how she deals with money, how she deals with investing. Very popular on social media as well, and yeah, she did really well. Really kudos to her as well.
Yeah, and starting just before COVID, if I remember
correctly.
Yeah,
yeah, exactly.
Taking a big hit, but still having that conviction and sticking with the
Yeah.
plan. But one of my favorites, look, you said Chuck, but I think having Manoush on the show, talking about high yield investing. But we know Manny has been asking us questions for years. He's highly engaged on both Twitter, on Facebook especially. So it was actually nice to have him on, talk to him, meet him in person, well, virtually in person, but to see his face. And that was one of my favorite shows.
Yeah. I always love it when some of our key people from the community come online. And I'm also always so amazed by how they keep their emotions in control. What I mean with that is not being so nervous that they kind of block themselves, right? Sometimes we had that we saw guests that really couldn't articulate easily their thoughts because they were so nervous, but somehow our guests that come from the community, they're really rock stars.
Yeah. And then the last two guests we had were two Irish guys. Wolf of Harcourt, who we had on the show before. He came on and spoke about Evolution Gaming AB. We know he's quite...
We did a deep dive on it, right?
Yeah, he spoke about the business and so on. And we also had Andrew on and spoke about investment trusts and some of the benefits and challenges of them. And as you know, it's been highly influential for me because I have started to invest a little bit more in investment trusts. And to Andrew's credit, if I ever have a question, or if I ever have anything, I could fire his way, and he's always quick to come back. So it was great having two of those on the show as well.
Yeah, no, definitely. So thanks to all the guests. Really, thank you. You really add a flavor to this podcast, and yeah, let's hope that we get many more next year.
Yes, one a month. That's our goal.
Exactly.
That's our goal. But there was other stuff happen. Like so much stuff happened throughout that year, and I went back through each of our show notes and looked at the news items, and we have them in bullet points. We don't always write everything down. The very first show notes of the year had Walgreens dividend cut. I was like, what a start to the year. What a start. And when you look back over all the events, I would have to say that it's a year of uncertainty, I would say. We've had a year of uncertainty kind of sticks out for me. We had lots of drops, 20% drops. We had a show on it, Target, Nike. We had dividend cuts from the likes of Estée Lauder. But we also had some companies initiate dividends.
Google, Google and Meta. Yeah. The growth stocks that started paying a dividend, right? This, I mean, many investors in those companies don't really like that, right? But we should not forget that, for instance, for Zuckerberg, if he wants to earn money from his investments, then he can borrow against his assets. Yeah. But why not just pay a dividend if you have anyway enough cash coming in? It's so much easier. You don't need to go in debt for it. You just pay yourself a dividend, and you cover your life expenses, right? So also for a founder, this is very interesting, and for Google employees as well that have tons of shares, right? These dividends can be quite impactful already for them.
Yeah.
So I'm just wondering, like, but we discussed about it last show, right? Yeah, I was thinking about Amazon should be next. I think it would really make the FANG a little bit complete now, right?
Yeah, but I'm still wondering what's going to happen to these big tech companies. We know during the year Apple were targeted, if I remember, because we got a lot of questions around that. What do we do with Apple with the US government coming on to them and all these regulations? What will happen? The likes of Google and Meta will the American government break them up and try and dilute them? Europe obviously is the same, trying
but
to.
I mean, this is not new to the world of the stock market. Yeah, now the Googles and the Meta are big companies, but we had AT&T in the past and such, right? They have always been really large companies that may start to get monopolistic behavior just because they gobble up the whole market, right? And then the government will put pressure for them to split up to keep a competitive landscape, because that's where capitalism thrives.
Yeah.
So this from all times, and that's why you have a few companies that are known for many spin-offs and such. Like even just like if you look at the Rockefeller dynasty here, I don't know how much the government had an influence there, but many companies like Chevron, ExxonMobil have their heritage in this. So that's not something new, and it doesn't mean necessarily that shareholders will be on the losing end. I mean, if Google would split off, let's say they would split off separate the ads business from YouTube and the cloud, and you get three companies, they can grow and thrive on their own again.
Yeah,
it doesn't necessarily mean that you're left with a cat in the bag, right?
Yeah, there's three strong companies that could actually grow themselves.
Yeah, why not? Why not? And maybe even better, yeah, because we spoke a lot about industrials, how Siemens is one of the last industrials that's still standing. Yeah. Well, maybe the current tech companies like Google and Meta are the industrials from 10, 20 years in the future from now. Yeah.
Be interesting to see how they go. But look, Amazon, they are due. They are primed. They are primed for initiating dividend. Let's see how that prediction plays out.
Yeah.
We love a good lawsuit on this program, on this show. we always love a good lawsuit, and there was a dozen or so last year. But Johnson & Johnson with talc was early in the year, 3M, and Bayer.
It just seems to be just very hard for them to settle at the moment. The U.S. government is not so supportive right now. I believe that Johnson & Johnson in January will hear again from court, from other states, whether they can really file this part of the business around the talc. I think they call it Red River. I mean, what a name! If they can really declare a bankrupt or not. Yeah, it's of course Senator Warren was again against it, right? They really try to prevent this because they feel like they're trying to walk away from their accountability, and then of course the payments will be limited to some extent as per the amount of money that is in that entity. But it seems to be very hard to get away at the moment, like PFAS, Bayer still with the Monsanto Roundup cases. It seems to be really hard to settle right now. And this makes it even more scary when your company gets such a big claim against you.
Yeah, it's a tough landscape out there. And that's why we try and the learning for me from this is to stay away from lawsuits. And typically when I see it now, it's a red flag. I'm gone. If I'm invested in them, I try and get out as
But how do you judge in the beginning the size of the lawsuit, right?
Yeah, well, it's big when it hits the mainstream news.
Yeah, but every company has some lawsuits.
They do, but they don't hit the mainstream news like that. You're not open up Yahoo Finance and finding like 1 or 2 million lawsuits or anything.
Okay, but what then about Shell and Nigeria oil asset?
I didn't see. I don't see them on like that. Hasn't hit the mainstream news. Well, at least I haven't seen that on that.
Okay, okay, so if you follow Shell, this is all the time for years already with the river delta in Nigeria, right? And the waste and the oil spills there. So I'm just saying, like with like this company again seems to fare well with it
Yeah.
somehow. Maybe it's because it's not so much impacting them in the sense of terms of revenue and such, and probably the other ones have like an unlimited revenue well, no, unlimited fine impact that could wipe out their entire balance sheet. That's
Like
probably the result here.
3M was the big one of those where it was
Yeah,
technically unlimited.
yeah. Well, Bayer as well. Still, we have
Yeah.
no clue. Yeah, that they're like whether it's 500 million or 10 million per claim. We don't know.
Yeah, we still
Yeah,
don't know.
but that's why it's now trading at 20 euros and not anymore at 70 or 80.
Yeah, yeah. There was threads of light coming from that for a while, but that
Yeah.
seems to have died away again. So I don't know where.
So I'm still, I agree with you on the learning, right? So that's why I'm asking these questions, but I
Yeah.
haven't settled myself yet on what to do, when, and specifically when. Okay, I get it. In hindsight, yeah, no, okay, I should sell this one earlier. For instance, I own still Johnson Johnson, and I have not really an issue with owning it. Should I sell it now or not?
Yeah, I did. I don't have Johnson Johnson.
Yeah.
I
So
don't have.
I do have, and I still see the opportunity there. So
Yeah.
maybe I just haven't learned my lesson yet. Who knows?
Yeah, but like each case is different. I suppose you can't take them all the same, but usually what's the common denominator in these? And you're right, it is gobbling up the balance sheet. It's cash flow. It's
Yeah.
impacting their dividends. When you look at Shell, I mean, it hasn't impacted anything there. We're still getting share buybacks. We're still getting double-digit dividend increases, but 3M cut their dividend. Bayer cut the dividend. Johnson Johnson is clockwork. It has one of the nicest dividend charts, but it's also got a AAA rated balance sheet. So it can probably soak that up for a bit. But
that's my thinking for now as well. Yeah.
Yeah. So
and also there is more estimation around the size of this, right? It was a little bit like with NN Group with the Woeker policy. You could kind of calculate the size of it, and you knew like, okay, they can deal with this, and then it was much less than I even anticipated.
Yeah, but a bigger red flag for me is the European company being sued in America.
There seems to be no senator that has shares in them, and they don't care anymore. Then
and we don't understand how to navigate that because it's a different system to hear. So
true.
Dividend cuts. We'll talk about dividend hikes in a minute, maybe our favorite ones, but we did have some dividend cuts. I was thinking before this, did I have any this year? And I was there, no, I don't think I did.
Yeah.
And then I remembered Enagás.
Yes, Enagás. Yes. Enagás and BASF, because I do own a few BASF shares.
Yeah.
And they announced already that their dividend next year will be lower. So the good thing is it hasn't really material impacted the share price. So that's the good thing. So you can really replace it with another high yielder, like whatever, one of the insurance companies or a utility, whatever you want. So this one's a nice one, an easy one, BASF. But Enagás was not a nice one.
Yeah, I think I have to give BASF credit. They did give us enough warning.
Exactly.
They gave us enough warning that this was happening. So that's why I think the share price did not react. It probably reacted to the initial warning more so than when it actually happened. But Enagás for me was the biggest kick in the teeth, I have to say, purely because management specifically said they had a dividend floor till 2028.
Yes.
So I was caught completely off guard, and without that guarantee, would I have invested in Enagás? Probably not.
Yeah, me probably neither. Yeah.
Probably not. So that was one of the main reasons, and that they had a high dividend yield, but it was safe. So I was not happy with Enagás whatsoever.
So it wasn't that safe after all.
No, never listen to management. That's never listen to management.
Yeah.
But what about some positivity? Dividend hikes. Who was your favorite of the year?
Yeah, the favorite of the year was, and it's actually a accumulation because start last year already, because it's a combination of the interim and the final dividend, but NN Group with around 15% on already a pretty awesome yield. Yeah, for me that was like really cash flow enriching. Also Shell. Let's not forget Shell, where Shell's coming from. They did last year 2 hikes. This year 1 hike, building on last year, and then we will get a new hike soon again, and probably announced in January, maybe in February. Very much looking forward to that because it's supported by strong buybacks. So if they do like 6-7% buybacks in a year, then they can at least already 6-7% dividend hike. So let's see what they will be doing. But another one was Evolution AB. Well, we know that this is a high grower, 32.5% dividend high. I think they made it from 2 to 265. I don't expect the same, to be honest. Going forward, I expect a much lower dividend hike due to how the business is now a little bit operating. But still, amazing dividend hike. But there were quite some double-digit hikes, specifically with a lot of American companies as well.
Yeah, Eli Lilly, Mastercard come to mind.
Yeah,
the recent ones.
yeah,
A lot of good hikes. I was looking at Evolution today, maybe after the news, and they're now over a 3% yield.
yeah. It's not too shabby, right? Not too
Yeah,
bad.
3% for what's meant to be a growth company. I'll take 3%, which is quite interesting, I found.
Yeah.
And then also we had these, like the stock market has been just crazy. We've had these flash crashes. We've had 2 or 3 of them this year, actually. But then we've had some share prices like Broadcom. Broadcom is the cat that got away. 25% in a day nearly, that was. And 25% overall, the market has grown. And obviously led by those.
Yeah, but this is crazy. Really, when you think about it, like 25%. And what did we have last year? Also, was it... So last year we had also a big year, and the year before we had 18% down, right? That was after 2021.
Yeah, I think so.
Yeah.
I can't remember off the top of my head, but it's not looking good for Trump.
No, but I was checking today. I saw from another guy on Twitter, I think TG, what's his name? TG Wellinger. He posted a chart showing TJ Terwilliger. Yeah, he posted a chart with the stock market returns of S&P 500. And in the lead up to 2000, it was like 4 years in a row, 20%. So this means if history repeats, we still have 2 years of like this kind of growth. Then it had 3 negative years, but the negative years were not too bad if you would take into consideration the 4 years leading up to it. Yeah, then over this time period, these 7 years, you still made a pretty good return. So, yeah. But then we had the last decade, as you remember, from early 2000s to 2010, almost nothing happened.
Yep.
So, well, I mean, when it comes to total return for the S&P 500, so I honestly would love to have a last decade a little bit, because it means that dividend yields will be much better, which gets me quicker to retirement.
Yeah, everybody says that, but then when it happens, they panic. That's what.
Yeah, well, I think I trained my emotions over the last few mini crashes that we had with 2020 as an example, 2016. So I think I will be fine with that one.
Yeah, I think so too. I think the last decade wouldn't be too bad. But look, we noticed the stock market, or the S&P 500, is held up pretty much by the Max 7. They're the majority of those gains.
Yeah.
So take them out. Maybe Congress are going to make sure that they are spread out and crash them somehow, and they'll be like Cisco. Remember the chart of Cisco back in 2000?
Yeah.
Up and down.
Yeah, this can happen now to them as well. Well, you know, c'est la vie. We will see.
Let's see. And of course, then iconic CEO changes. Starbucks has been one, Intel just recently, and also Nike. What do you make? What do you make of those?
Yeah, I mean, what a shite, right? This one from Starbucks.
Yeah.
What was his name again? Sarah Tivinas or something like that. The one from Reckitt Benckiser.
Yeah, he's gone. I can't remember his name, but he was.
I mean, he went from selling lube and everything to putting together the former CEO putting lube in the coffee in the terms of olive oil. I mean, and then they say we need to communicate the value better.
He just didn't understand the company.
No, really not. Honestly, I think sometimes you just see it that it's the wrong person, and I'm glad they took so quickly action and didn't let it muddle along.
Yeah, Yeah.
because he seemed a really nice guy, but he made such a fool of him when he was on CNBC talking about that was the beginning of the end of him. I mean, that was like the climax of his incompetence, let's say, to lead that company.
Yeah, yeah. But look, he came from Reckitt Benckinsale. It's a big difference going to a massive, massive company like Starbucks from where he came. He did a good job before that, so he had some pedigree behind him. He just did not understand the culture. He did not understand the company and what it meant. Just
but if you then come on, Derek. I mean, I'm not a CEO. I'm not qualified to be a CEO like that. For that, definitely don't have the experience. But to go on air and to say we didn't communicate the value of our coffee enough. I mean, come on. You wouldn't say that.
No, you wouldn't say that.
You would probably say in an Irish gentle way that this coffee tastes like shite, yeah, or something like that. Yeah, and then that we need to work on this, yeah. But you wouldn't say like didn't communicate the value of coffee enough.
Yeah, he was
like it was a communication issue, nothing else.
Nothing to do with coffee or culture or keep people in your stores or getting rid of all the seats in your stores. It was communication. But look, wrong man for the job. And then Intel and Nike probably makes sense. Intel, I actually read that. I mean, it's funny, but shareholders want to sue or take back the last 3 years' salary from Pat Gelsinger.
I think I don't think it stands really in court, but I would agree that if you see the salaries that CEOs get, I'm very much in favor in it, as long as they fucking perform.
Yeah. That's why most of them are performance based. But then what are these metrics that they're being based against?
And that's where the governance comes in, and that's where like your board and everything, if it's full of friends, it's not really helpful. So I mean, books have been written about this. Many master theses and PhDs have been done about this, about compensation. In the end, it comes back to the moral of the CEO itself, and I always see a big difference between founder-led CEOs and the corporate CEO. The corporate CEO really has a different incentive.
Corporate CEOs have come through the system. They speak a certain way. They say lots of buzzwords. They know how to dance around these things. Where a founder CEO he didn't learn that way.
No.
He's built a company and
they have a far stronger emotional connection, I think, to it because it's their baby.
Exactly, and they probably don't look at the compensation. They look at the legacy of building that company.
Exactly. And probably the typical corporate CEO knows that they're like a temporary pope, just for a few years. And so cash in as much as you can, make some of your friends happy there so that they think good about you. Try to reach the front page of Forbes if you had a good year, and that's probably it.
Yeah, and you're set for life. Sit on a few boards, chair them.
Exactly, and then you sail on your nice yacht.
But look, quite a turbulent year, I would say. I noticed through that there wasn't too much happy news. There was a lot of downs, a lot of things that were.
But I think there were so many dividend hikes. That's the good things. But how much can we say about that? We will talk about the performance maybe next week or the week thereafter, one of those weeks, right?
Yeah.
Then we zoom more in on our personal happiness, but. Like you said, it was a very volatile year, and we didn't even talk about Bitcoin breaching the 100,000K. Did you ever think that was possible?
You know what? I never really gave it if I did, I would have definitely held on to it when I held it all those years ago. But I never really gave it a second thought. I don't have FOMO over Bitcoin. I really don't.
Yeah, you owned one once, right?
I owned one. Yeah. I owned one when it was. Yeah. I had one full Bitcoin. I did. And you know what? I sold it and invested in this other thing called Spectre. I believed in the project and all that. And it turned out then, it was maybe a little bit before I was a dividend investor. It turned out that they actually paid dividends as well in this. And I was like, oh, great, wonderful. And that was the biggest heap of shite I've ever invested in. So Yeah, don't take crypto advice from me.
And then
If I
and
had
then
known,
you,
if I had known.
and then you use those remains probably to pour it into Walgreens.
Yeah. Walgreens Intel at 60. But yeah, it's crazy. And someone put up one of these charts, and you see these charts every so often with
Yeah.
Bitcoin, where it shows the history and it's
Yeah.
parabolic and where we're at. And every time they've been right, to be honest. And it looks like from now, if you were to believe
Yeah.
that it can happen, it can go to 400K. Who knows?
Yeah.
Who knows with Bitcoin? Who knows? But it's just as volatile as stock
Yeah,
market.
it's volatile, but if you look at it from a risk point of view, it may have a total different story, and it may be quite conventional, actually.
Yeah.
And you would argue that if you're really into total returns, if history has taught you anything, you should be full into Bitcoin.
Yeah, no.
Because it's the asset class that performs the best so far in the last decade.
If you have the stomach for it and you can take the downswings and take the risk, I 100% agree. But that's
Take the volatility, you mean?
Yeah, exactly. That's my problem.
Yeah.
I can't. That doesn't suit my risk profile. I can't do that. But people have got rich because of it, and I applaud them.
I wonder how many people bought 1,000 and held on to it till 100,000.
Yeah, I would not say it's as many as Twitter would leave you to believe.
Yeah,
it's struggle because we had a show that we had a show and it was Bitcoin was dead. It was dropping to nearly 30K. That was this year.
Yeah.
And the narrative was negative, and then it shoots up. And
if we know the majority of the stock market and retail investors and their emotional swings,
yeah,
it is probably like buy 1,000, sell at 2,000, buy back at 1,500, or it would be like buy at 2,000, sell at 1,500, jump in back at 3,000, and sell at 2,000, probably more. But yeah.
That's where it falls down for me. If you're a total return investor and you're in something that volatile, emotionally, how do you handle that? And some people can. I just can't. That's where dividends help me, because yes, it's we do get drops. We've had 20% drops in Target, Nike, Starbucks. We said this, but the income doesn't drop 20%. And that's what keeps it steady. So I've no FOMO over Bitcoin. Some regret over not holding on to that one that I owned long ago.
Yeah, and if you bought if you had a 3,000 and then now at 100,000, you will be all the time scratching your head like, oh, shall I cash in? This gives me like 3,000-4,000, maybe 6,000 in dividends.
Yeah, but I could tell you, I never would have held that long. When it got to, I remember it broke 20,000. That was a big milestone. I definitely would have sold it then. But if I didn't, when it got to 40, I definitely would have sold it then. I never would have held that long enough to get to it.
But this says again that this confirms actually that kind of the best performing investors are those that are dead and people forgot about their portfolios.
Yeah. So if my wife had to kill me back when I had one Bitcoin, she'd have more money now.
So what's the lesson here? Poison your husband on time. Do not try this at home, by the way.
Yes. But yeah, quite a fun year, hasn't it been? It's been really, really fun to actually navigate this, doing the show. Learned a lot. Actually, we didn't even mention the Fed. The Fed every 3 months were releasing some news and
Fed.
up and down. So
maybe that's where the term "fed up" comes from. Where does the term "fed up" comes from? Do you know this?
I do not know, but
I'm fed up of this. It must come from the Fed, from like the 1920s or something like that, the Great Depression. We're fed up with this. Good. Hey, like you said, let's close out this main topic for today and let's go to some of the listeners' questions, which are also all about this. So the first one is from Dom Perry Pirat. And he asks, like, hey, you guys have done an amazing job this year again. Well done. And he asks what dividend hike would make us the happiest in 2025. For example, 10% on SHEL. Well, definitely. SHEL, 10% up. I would love it. I would really love it.
SHEL, of course. Yeah. I mean, what one would make me the happiest? That's like asking to choose which family member is your favorite. It's such a tough question.
Deep inside of you know which son is your favorite.
Yeah. But you don't want to tell anyone.
No, you will tell nobody.
You tell nobody. They're all the same. They're all the same. But you know what? I have all three in my portfolio. I have them quite a while. They're my highest paying, I think, is
Mhm.
of their dividend yield. So if they had a big hike, which I don't expect,
Yeah.
I think they would push me well over the 10% yield on cost, which we know
Oh,
is
nice.
which
Yeah,
is
yeah, yeah, yeah.
a notional thing, but it's still a nice thing to
Yeah,
have. So
yeah. Awesome.
I'll go with them. Your Shell, you stick with Shell?
Yeah, 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 definitely, definitely. It's my highest dividend payer, not in terms of yield on cost, maybe, but just in terms of absolute volume. So a double-digit hike on that one will really help with my forward dividend income.
Nice. Dividend Controller has asked us about our greatest learning this year regarding investments or life in general.
So let's stick it to investments for now. But for me, it is like that the market can stay longer irrational than I ever thought. Yeah, or like was it Buffett, and then anyone can stay solvent.
Yeah.
But I mean, I put here for in our show notes, I put the PE multiple of the S&P 500, and look at this one since COVID already, right? It's now trading at a 30 multiple, which means it has a lot of expectations in there, right? And we saw it in the 90s, late 90s, also being at this level, and then it still spiked to 45. That was when it was crashing, actually. So the same was in 2020, but it was also at the bottom almost of the crash because the earnings were still there. So for me, when I look at the last few years and I see these multiples, I just feel like, I mean, is there really so much growth in the company? Because we're not anymore at a zero interest, right? We're
Yeah.
now at a several percent interest rate environment. And that's what I don't understand. I understand the AI boom. I understand the Mac 7. But this is a lot of growth priced into the market. Really a lot.
Yeah, it looks kind of on average if you compare it from the 1990s on, kind of. Definitely before that, it's way above, but who knows? You're right. The market is irrational, and I just don't know what to make of it.
Yeah,
I
but
really
you
don't.
read about it for many years, but to really feel it, that's for me really what I felt this year. Like
Yeah,
all the time, like how is this 25% again? Like when will the market come to back to its sense again? That's really the feeling that I have.
yeah, yeah. It'd
I
be
like
interesting look
yeah,
back on
but
it.
what was it? Waste management. What
Yes,
do they have? A 40 PE or something like that? Who wants to pay a 40 PE for trash?
but that's what I was going to say. If you look back, will that be the new baseline? Like all the books we read now are back in time, back in the 70s, 80s, even early 90s. They say 20 PE was the baseline. That's the highest you should go. Is that now going to jump to 30 based on the last 20 years? Is that your new baseline?
No, I don't believe so. I simply can't. Okay, so waste management is now a PE ratio of 31,
Wow.
trading 12 months. I mean,
There's a lot of growth priced into that.
precious. Imagine those poor citizens and what they have to pay for their trashes.
But I 100% agree. The market is irrational. From up, look, we just spoke about the double-digit returns we had over the last 2 years, and if history repeats itself, we have another 2 years. But the market is just crazy high at the moment.
Yeah.
We know that. So what can you do? But my biggest learning comes around turnarounds. Turnarounds don't usually turn around too easy. We've seen that quite a bit on a few of them. At one stage, I felt like we were going to be the turnaround show. We were talking about so many of them, and I don't think there's been a good news story around any of the ones we spoke about.
Well, Shell cut the dividends, turned it quite quickly around.
Yeah, true. Shell was the only one, but the rest of them,
No,
a disaster. So
no.
my biggest learning is if I'm looking at something and turnaround comes out of my mouth,
Yeah.
I'm shutting down my laptop, I'm throwing it away, and I'm never investing in that company. I don't want anything to do with it. Goodbye.
Yeah, so true, so true. But there's a difference between a turnaround and just a company needing to put some focus again. Turnaround for me means like this, something inherently broken in the company.
Yeah.
Yeah. So I give you an example. For me, Starbucks is not a turnaround, or Nike. Yeah, they have sales headwinds. They made some choices over the last few years that put a little bit um, their sales under stress, but I don't see it as a turnaround. Like Intel lost totally the boat, yeah, on the innovation. It's a winner takes all market. For me, this is a clear turnaround. Yeah, that went wrong. But for me, Nike and Starbucks, they just have some headwinds, made some decisions that they can easily recoup. Well, easily is maybe a big word, but they can, with some management actions, they can quite quickly
Yeah.
turn that again, yeah, to the right direction. But for me, it's not a turnaround. Those turnarounds really means like your business is at, like we just spoke earlier about this real estate investment trust. Your business really at a severe issue that it can really hit the longevity of your company.
Yeah.
That's for me more the definition of a turnaround.
Losing a lot of market share without a competitive advantage to get it back. Like
Yeah, yeah, like Walgreens.
yes, like
Yeah,
Walgreens.
yeah, like it's, you just see the business deteriorating. I don't
Yeah.
see that with Starbucks and Nike. Yeah, I see more some geopolitical topics, China and such, but I don't see anything there where you say like this company is inherently broken. I mean,
Yeah.
the coffee was expensive 10 years ago already, so that's not the thing, right? Here.
Yeah. Yeah. No, I kind of agree, but I'm at the stage now where there's so many good stocks out there, good companies, good investments.
Yeah.
I don't have to be a hero and try and determine if it is a turnaround or not a turnaround.
Yeah, that's true, but there are also probably enough stocks in your portfolio. Not everything goes nice.
Yeah.
Not any stock. None of the stocks go nice up in a nice exponential way. It
Yeah.
always goes like up, down, up, down, up, down. There are seasonality in the business as well, in the terms of like, okay, they had a good year, then they have a little bit of a less year, and then when the less years, the beers come in, they talk a little bit more about what's all bad about the company. So this is just normal when
Yeah.
investing. So
Yeah.
for me, it's also again like what I mentioned earlier, also about drawing the line. Where do you draw the line of a turnaround? Because I was also thinking about this learning, and for me, it's really like if the core part of the business is under threat and a potential existential threat, and that's hard to spot in the beginning. Yeah,
Yes.
so that's where you have maybe the boiling frog analogy, and Walgreens, I think, is really a good example of a value trap because it was not like overnight. Yeah, I
No.
remember all the time, like you talking about Boots Alliance and such. Yeah, so, but that
Yeah.
was more like a value trap, I would say. And these are really hard to spot, really hard to spot.
Yeah, I agree. That Village MD, they spoke like it looked really good about their plans around that.
Yeah.
Looked really good, but in the end, it turned out to be a value trap. And I think Intel fell into that a little bit as well, especially when you saw the likes of Nvidia and the market share that they were
Yeah.
gobbling up, and
Yeah. Yeah. Yeah.
AMD and
Yeah.
Intel were always late,
Yeah.
always late with
Yeah.
their chips.
So I will not jump into a turnaround anymore so quickly, I think, as I did in the past. But it can be that your company turns into a turnaround that you hold today.
Yeah,
And then that's where I'm thinking more when I'm talking like this.
yeah. And if your company turns into a turnaround, that's when you have to make a decision when to sell.
And this is very hard because you have confirmation bias. It's
Yes.
really hard to not fall in love sometimes with a stock, specifically if you spend a lot of time on it, if it has been always good for you. Yeah, but we also know that every good company one day turns bad. Yeah, just good companies go bad.
Yeah, yeah, yeah. Just takes one bad manager to spoil the broth. But
Yeah.
yeah, I agree. Now there is a line, but I think if I'm looking at a new company and I have a feeling it's a turnaround, I just stay
Me
away.
too. Me too. So for now, we keep it to a feeling.
Yes,
Yeah.
yes. Emotions. Centrino, this is to you specifically.
Yeah.
So if children are still living with you, as they grow, your expenses will grow during several years. How do you take this growing expenses into account in your FI number?
So first of all, I expect my kids to work. Yeah, like when they are 16, I expect them to work during the summer holidays. Expenses in Poland for education are not that high. They can live at home. So I do take into account, right, the expenses, but not to the extent of the American family, where I know that I have some American friends. They are just trying to save 100 or 150K per kid for their college degree. I'm not doing that. Education is kind of for free here. We live near the universities, so they can easily commute, and those are one of the larger expenses, I would say, that you can foresee. But generally, yeah, that's all incorporated. Yeah.
Okay. Quality Dividend Growth has asked us about dealing with positions that get increasingly expensive. So he's got Apple, bought it a few years back, has got an insane return, but it's kind of stopped growing and is as expensive as before. And this is a dilemma that you have right now as well. So
Yeah, it's I don't have a Microsoft because I really see the good growth. It's like the flywheel is
but
flying
Apple,
on all. But
but
Apple for
Apple,
me is the same thinking that I have. Like, look, it turned into a growth company. The dividends, it is, yeah. It will need to still grow many, many years for the dividend to become meaningful. But I don't have the same growth expectation and conviction for Apple as I have for Microsoft, as an example.
yeah,
But I also know I don't want to cut the flowers and water the weeds. Yeah. So what do you take for it in return? That's also the question that I have in my mind. But
yeah,
Apple is a good one. I mean, in the end, I think so. Letting your winners run, that's really a lesson I pay the price for, that I wanna really adhere to. Just with Apple, I think, like, okay, but has this winner now run out? Yeah, is that
yeah.
is that the way? So I don't know.
That's always the question. Like, let your
Yeah,
winners run is always easy to say, but at some point,
yeah,
we
but
just said every good company turns bad at some point.
yeah, but
And
for
this,
instance, Microsoft, I can see them growing into the multiple. I don't see that really with Apple at the current multiple. I really don't see that.
yeah,
It is a cash machine. It ticks all those boxes, but the buybacks don't really make a lot of they don't make a lot of contribution at these multiples. Let me check what the multiple is now for Apple.
but
Uh,
when I listen to you
yeah,
talk about
42
Apple,
PA ratio. Yeah.
when I listen to you, you lack conviction. And that's what I hear. You lack
Yeah,
conviction.
yeah. I don't have the same conviction, and I mean I have conviction that this is a great business.
Yeah,
Yeah, but I would for God's sake, I would never buy it at this price. Never ever. I bought it at a 13 multiple. It's now 42 multiple.
yeah.
Yeah, and it grew the revenues and the earnings really nicely year over year, but 42 is not justified.
Yeah. Nice. Quality dividend growth. That does nothing to answer your question. Probably
No,
muddles the water a little bit.
just
But
that we share the same dilemma.
yeah, it's a tough. I mean, look, it is a tough. It's a tough one, particularly with the types of company you're speaking about. So I don't know. I probably would sell it quicker than you would. I would say if it was me.
Yeah. Well, but I had these thoughts many times, and I've done well by not selling them.
Exactly. Yeah, exactly. Roca has said the biggest and most effective lever for investing and wanting to stick with it is a strong reason or goal. How has this changed for you over the years and why?
It hasn't. Since 2014, I just plugged in the data in my template, and it told me that after 15 to 17 years, if you stick to this plan, you'll be financially free.
Yeah,
And that's my goal has not changed in those years. My learnings have, my performance has, but my goal's not.
yeah, I'm exactly the same. It's all about financial freedom, financial independence, and that has never changed. But it is a big enough reason for me to stick with it.
Yeah,
Something,
yeah.
something I want.
The desire maybe goes in ups and downs over the years. Yeah, sometimes you wonder, like, oh, do I really need to be financially free or not? Yeah, but no, the desire is still strong enough.
TJ, any thoughts on Teleperformance SE?
I haven't looked deep into it, to be fair. I always shied away a little bit from the business. My struggle is really, what with large language models and AI, is their business sustainable enough, and is management capable enough to jump on this opportunity that it has been given? So
Yeah, it's tough. It's tough. I haven't looked at it. Customer service is always one that's a difficult one to.
yeah, I mean, AI, the voice recognition becomes so realistic. The question answers become so good with large language models. If they can apply a large language model to their data sets, and therefore have the customer service automated as much as possible in a reliable way, then Teleperformance could be sitting on a honeypot here, right?
Yeah. But I don't know if you see that now, trying to reach customer service of any type of company like Ryanair, or Sports Direct, you have to go through bot after bot after bot. It almost breaks your heart that you stop and you give up because you can't.
I do think that we are entering the stage that people like you and me just want to have a person on the other side of the line, and we're probably even willing to pay for it to some extent.
Yes. And maybe there's a business model for them. They can generate more revenue.
Yeah.
El Kuba has said, what's your predictions about the German economy in 2025?
I totally have no clue, but from what we hear from Germany lately, it's not going into the right direction. I think they declared new elections somewhere in January or February. So yeah, it will be fun again there.
Yeah, Europe is struggling, but let's see. David has said, most people in the investment world know about Buffett and Munger and Lynch, of course, but most don't know about Howard Marks. Have you guys listened or read his memos? They can be found for free at Oaktree Capital or his audio version on his podcast.
Yeah, actually, I read his book 2-3 years ago. I forgot the name of the book, but if I remember correctly, it was about debt investing and how's it in relation to the debt cycle that we are in. I mean, Howard Marks for me is a genius, and I love that. Like Ray Dalio is another one. Howard Marks and Ray Dalio, they share so much wisdom with us. It's just there for grabbing. You just need to spend time listening and reading it. A lot of knowledge is what they are sharing, and Howard Marks also talks in a really nice way to listen to.
Yeah, two books that I had on my list, I haven't got them yet, was The Most Important Thing, and the other one was Mastering the Market Cycle.
Yeah, that one I read, Mastering the Market Cycle.
MH79, how much did you increase your dividend income in 2024 in comparison to 2023?
I don't know yet. It will be part of my analysis for the annual report.
Yeah, I can't remember off the top of myself. I think it's around 20%, but we'll probably do this next week. So we'll have an answer. We'll have an answer for that next week. Thomas has said, due to a major, this broke my heart when I read it because I'm going to be in a similar situation, but due to a major rebuilding project on your house planned in 2025, I see that we need to sell down 20% of the portfolio. This gives us some more insurance and funds available for all the unknown costs. I struggle to see which stocks I should sell and still have conviction in all of them. It's a hard one. So how do you determine which positions to sacrifice?
Oh, I couldn't say. I mean, flip a coin. I really don't know.
Probably tax comes into it a bit for me as well, because I think the whole point of this is just selling because you need the money. You don't want to sell and give away let's say 20% of that for no reason if you can avoid it. So I think selling the ones where you have the most tax advantage, if you're in a loss like tax harvesting, would be where I would start. Even if I had conviction on them and I need the money, I would rather sell and not have to pay tax than sell maybe a winner and end up losing 20% anyway. But it's such a such a tough position to be in. And I noticed, I said this on the last show, that we're looking at either moving or renovating or so on. Quite a big expense. And my non-negotiable is to go out my portfolio or even stop my investments. But I know how hard this decision will be. So I don't envy you, Thomas. It's a tough position. But look at I'd say maybe get an accountant, look at the tax, and see where you can save. Start from there. Christian, are there any stocks you regret you didn't buy this year? Big kind of stock.
No, I do have it sometimes that I regret something, but there's nothing that really comes to mind at the moment. No, I mean, the only one that I keep a little bit every time when I see the ticker, I feel a little bit bad, and that's about Snap-on. Every time I see that ticker, I feel like, oh, I should have bought it.
Yeah,
But the rest, not really.
This year alone, I don't think so. There's been a few. ASML was another one. Broadcom was one. But hindsight's 2020. So
yeah, but I also jumped on almost most of the opportunities. Yeah.
It's hard to know, but no, I don't regret anything I didn't buy. There is some companies I would like to buy, but their yields are too low or something. So it's hard to justify. Like I would love to own Visa or MasterCard. Like that 10-15% dividend hikes nearly year on year. It's just their starting yield is less than 1%, so it's tough. So I regret that I can't buy them, but I don't regret that I don't buy them. That makes sense. Eoc has asked us, curious to hear your thoughts on OMV.
We haven't looked into it.
No. I missed that question, so I didn't look into it, but we'll add it to the backlog for next week, so we'll have a look at it. Pete, question for me. What do you expect your current goal of 1K dividends a month will look like? So how long will it take me to get that? I would say another 2 or 3 years, I would say. I'm halfway there. So let's see. 3 years is my goal with that. Maybe before, who knows? And question for you, is your fire project, projected on Dutch cost of living or Polish?
Polish. I live here and I intend to live here. So I also earn my salary here.
Yeah. Makes sense. Tim has said, imagine there was a huge crash in 2025 and your paddy went down. That means there's lots of dividend cuts.
Yeah, exactly.
Would you react or just accept a lower dividend income for the short term, pushing out your fire date?
Yeah, what else can you do?
Yeah,
I would seriously ask myself, like, where did those dividend cuts come from? And actually, I did go. What I did do is I applied all the dividend safety scores that we have with our premium newsletter to my portfolio, and there are 7 on the list that have a questionable dividend.
Yeah,
2 or 3 of them I accept, like Omega Healthcare as an example here, because those are high yielders that I know. I know why I own them. Let's consider that a part of the high yield part of the portfolio. And the others, I'm thinking of disposing, because and with that I hope to strengthen the safety profile of my portfolio. Let's say like that.
Yeah.
But and then if it then happens, I would be really wondering, like, dude, where did this come from?
Yeah, I was thinking of a similar. I started a similar project on my portfolio doing that because I think that's quite important. One of our learnings, and we write about this in our newsletters, dividend safety matters. Matters probably more so than my emotions. And 9 times out of 10, it's correct. But if we have a crash and our projected annual dividend income goes down as well as the crash, that means it's a bigger crash than what we've ever seen before.
That must be a 2008 kind of crash. And I even would be okay if my paddy goes a little bit lower at that time, because then there's really typically a clusterfuck in the market, right? And then you get to deal with like LVMH did in 2020, that some management gets scared because they are in the blast zone, for instance. Yeah, because for them it was like no foot traffic because there's a lockdown. Who knows if anyone can buy a bag? Yeah.
Yeah.
And if the blast zone is big enough, because it's such a big crash, this is more likely to happen. And then you can do all the dividend safety analysis of the world. When the companies are in the blast zone,
Yeah.
something else mattered at that moment in time. Yeah. And then I'm kind of okay with it. Yeah. Knowing that those companies do everything to get as much as possible back once the dust settles.
Yeah. Yeah. It's something that I need to think about a little bit more in terms of safety, but would I just accept the income for the short term? I think I would have to. I think I'd have
Yeah.
to. I think I'd have to study that, depending on the type of crash it is, but you'd have to study the companies in that moment that didn't cut
Yeah.
the
Okay.
dividend.
Okay. Simple. A war breaks out in and spills over all the way through Europe.
Yeah.
Yeah. Come on. You can't expect that your European part of the portfolio, which is 40% for me or 35% for me, is safe at that moment in time when half of your consumer base may fall away for whatever reason.
Yeah, but also if that happens, I'm probably not concerned about my portfolio at all.
Well, it depends on where you live and what your status is at that moment. Yeah, but just saying, because when I studied Unilever, I studied about Second World War, and there were, of course, a lot of dividend cuts during that time. Yeah, so and these things can happen. Of course, I hope not. But yeah, well, then you just take it on the chin. Yeah, you can prepare as much as you can. You need to believe in your portfolio, but if everything gets dragged down in the market, and we get a Great Depression or something like that, yeah, then the putty will go lower. But hey, I will be still better off than most of the people around me. And sell it if it's like a 1 in 100 year or twice in a 100 year event. Okay, come on, that's we'll deal with it.
Exactly. Good question, though. Good thought-provoking question. Matthew, hope you had a good Christmas, and thanks for the podcast. As you reflect on 2024, are there any investment decisions you wish you had taken and any that you regret?
No, I have really a feeling that I doubled down on almost every opportunity that was presented to me this year. I also spend a little bit less on dividend stocks this year because of a car that I bought. I feel very happy with the car, good value for money. It's just a hit that I took this year. Effectively, I bought a more expensive car than I reserved the money for, because I put every month some money aside for the car, for a new car. And I feel still very happy with it. So it was money well spent for me. No, nothing that comes to mind.
Yeah, it's a tough one for me as well, because my portfolio matched closely the S&P 500 for most of the year. Coming up near the end, gap started to widen, but I still hit 20% plus in total returns.
Mm-hmm.
And my dividend income, I don't have the number, grew a lot more than last year. So it's hard for me to say I regret anything when I've had a good year. If I'm honest, so it's a tough one. Maybe it's something I need to think about for next week's show. But at the moment, I'm quite content and happy with how the year went.
Yeah.
Alexandros, what are you most looking forward to in 2025 from an investor perspective?
Well, meeting some people with Dividend Day in January or whenever we plan it, right? That's one. Secondly, just dividend hikes. For me, the February and March time when all the annual reports come out, that's always a joy. So I'm really looking forward for all these dividend hikes coming up, updating my G sheet with that the portfolio template, and see what the positive impact is to my portfolio.
Yeah,
I'm really looking forward to that.
I always look forward to see what the cycle is, what sector is going to be stressed, and where is there opportunities. So
and another one that I'm still reading through the Income Factory book, so I'm still wondering, should I allocate more to high income in my portfolio or not? That's the question I got. Yeah, you had the same, of course. You get influenced by what you read.
Yeah. Yeah.
So I'm more curious to see what it will do to my investing style. I do think usually nothing, but maybe I get more tolerance for a few high yielders. Who knows?
Yeah. But it has influenced me, and I have a portion of my portfolio based on that. But we just spoke about dividend safety, and that's the hard bit for me is those, where do they sit in terms of dividend safety? Because our algorithm might not be 100% correct to that. And then
Why you mean from our premium service?
yeah, so for a company like JP Morgan Income Growth, right? It's different than analyzing.
Yeah, but it's just not having a safe dividend then. It's simple as that. So you take on the risk of dividend cuts. And then you need to, how I think about such things, then you need to start thinking about margins of safety. Yeah, do you take then a 30% margin of safety on that part of the portfolio, 40%? Then you need to think like, what's the likely dividend cut that you could stomach, right?
Yeah, it's an interesting one. I have about 20% in investment trust. So
Yeah, because for me, it's like I want my dividend portfolio to be built at least for 80% on safe dividends.
yeah,
Then there's like, in the past it was 10%, but my portfolio grew. Then there's like 5% space for growth. I've got about 5 to 10% for high yielders, let's say. That's always been, yeah? Because I think 100% pure dividend growth, I mean, depends on what you want, right? But for others, they say like, I take 40% in all world index or 80%, and the other 20% I do dividend growth stocks. Yeah, everyone has their own flavor to it. But for me, I need to check. But surely it's minimum 80%. I think it's rather around 90% for me dividend growth, right? And then the question is, will I make it 80% or 90%? Stay 90%. That's my terms of thinking around income factory investing.
Yeah, it'd be interesting to hear your thoughts when you finish the book, and I'd love to get Steve on the show.
Yeah, I need to get back to him because he said initially that he wanted,
would.
but then we have issues communicating with each other via email, via Seeking Alpha. I mean, it really depends on where people have their attention span. So
yeah. We'll get him on the show and see. But
yeah,
curious to hear your thoughts when you finish. So that's it. That's the last question. That's the last question of 2024. I just want to thank all of our listeners for the whole year, for all the questions, all the engagement. We have hundreds of emails, nice emails, some challenging emails that we love those as well. But I want to wish you all a happy new year, and hopefully we'll have plenty of dividend increases next year. So thanks a million, and also thanks to you for being my partner in crime throughout the year. It's been a pleasure.
Thank you, my friend.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.